Part 1. Margin of safety. Summary. Avoiding loss should be the primary goal of every investor. The way to avoid loss is by investing with a significant margin of safety. A margin of safety is necessary because valuation is an imprecise art, the future is unpredictable, and investors are human and make mistakes. Investors are frequently lured by the prospect of quick and easy gain and fall victim to the many fads of Wall Street. Value investing, the strategy of investing in securities trading at an appreciable discount from underlying value, has a long history of delivering excellent investment results with very limited downside risk. It is easy to stray, but a continuous effort to remain disciplined. Avoiding where others go wrong is an important step in achieving investment success. In fact, it almost ensures it. Value investing requires a great deal of hard work, unusually strict discipline, and a long-term investment horizon. It is necessary instead to understand the rationale behind the rules in order to appreciate why they work when they do and don't when they don't. The correct choice for investors is obvious but requires a level of commitment most are unwilling to make. Most investors are primarily oriented toward return, how much they can make, and pay little attention to risk, how much they can lose. A margin of safety is necessary because valuation is an imprecise art, the future is unpredictable, and investors are human and do make mistakes. Value investors invest with a margin of safety that protects them from large losses in declining markets. Once you adopt a value investment strategy, any other investment behavior starts to seem like gambling. To investors, stocks represent fractional ownership of underlying businesses and bonds are loans to those businesses. In reality, no one knows what the market will do. Trying to predict it is a waste of time, and investing based upon that prediction is a speculative undertaking. There is comfort in consensus. Those in the majority gain confidence from their very number. Note, this is a great way to think about why we go along with the crowd, the comfort of consensus. But there is one critical difference: investments throw off cash flow for the benefit of the owners. Speculations do not point for the return to the owners of speculations. Depends exclusively on the vagaries of the resale market. Stocks and bonds go up and down in price, as do Monets and Mickey Mantle rookie cards, but there should be no confusion as to which are the true investments. Investments, even very long-term investments like newly planted timber properties, will eventually throw off cash flow. A machine makes widgets that are marketed, a building is occupied by tenants who pay rent, and trees on a timber property are eventually harvested and sold. It is vitally important for investors to distinguish stock price fluctuations from underlying business reality. Prices move up and down for two basic reasons: to reflect business reality, or investor perceptions of that reality, or to reflect short-term variations in supply and demand. Avoiding loss should be the primary goal of every investor. The avoidance of loss is the surest way to ensure a profitable outcome. The actual risk of a particular investment cannot be determined from historical data. It depends on the price paid. The effects of compounding even moderate returns over many years are compelling, if not downright mind-boggling. A corollary to the importance of compounding is that it is very difficult to recover from even one large loss, which could literally destroy all at once the beneficial effects of many years of investment success. An investor is more likely to do well by achieving consistently good returns with limited downside risk than by achieving volatile and sometimes even spectacular gains but with considerable risk of principal. An investor who earns 16% annual returns over a decade, for example, will, perhaps surprisingly, end up with more money than an investor who earns 20% a year for 9 years and then loses 15% the 10th year. Investors must be willing to forego some near-term return, if necessary, as an insurance premium against unexpected and unpredictable adversity. Rather than targeting a desired rate of return, even an eminently reasonable one, investors should target risk. Treasury bills are the closest thing to a risk-less investment, hence the interest rate on Treasury bills is considered the risk-free rate. Value investing is the discipline of buying securities at a significant discount from their current underlying values and holding them until more of their value is realized. An investment must be purchased at a discount from underlying worth. Above all, investors must always avoid swinging at bad pitches. First, since investors cannot predict when values will rise or fall, valuation should always be performed conservatively, giving considerable weight to worst-case liquidation value as well as to other methods. Graham was only interested in buying at a substantial discount from underlying value. By investing at a discount, he knew that he was unlikely to experience losses. The discount provided a margin of safety. Because investing is as much an art as a science, investors need a margin of safety. A margin of safety is achieved when securities are purchased at prices sufficiently below underlying value to allow for human error, bad luck, or extreme volatility in a complex, unpredictable, and rapidly changing world. According to Graham, the margin of safety is always dependent on the price paid. For any security, it will be large at one price, small at some higher price, non-existent at some still higher price. How can investors be certain of achieving a margin of safety? By always buying at a significant discount to underlying business value and giving preference to tangible assets over intangibles. This does not mean that there are not excellent investment opportunities in businesses with valuable intangible assets. By replacing current holdings as better bargains come along. By selling when the market price of any investment comes to reflect its underlying value and by holding cash, if necessary, until other attractive investments become available. Give preference to companies having good managements with a personal financial stake in the business. A market downturn is the true test of an investment philosophy. A notable feature of value investing is its strong performance in periods of overall market decline. Whenever the financial markets fail to fully incorporate fundamental values into securities prices, an investor's margin of safety is high. Value investing is, in effect, predicated on the proposition that the efficient market hypothesis is frequently wrong.